The methods used to analyze and predict the performance of a company's stock fall into two broad categories: fundamental and technical analysis. This video lesson provides a brief introduction to technical analysis. Those who use technical analysis make buy, sell, and short decisions based on peaks, bottoms, trends, patterns, and other factors that they notice affecting a stock's price movement. It is a technique that takes practice to succeed at. So what exactly is technical analysis? Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, past prices, and volume. Technical analysts do not attempt to measure a security's intrinsic value. Instead, they look at a stock's charts for patterns and indicators that will determine a stock's future performance. Technical analysis has become increasingly popular over the past several years, as more and more people believe that historical performance of a stock is a strong indication of future performance. The use of past performance should come as no surprise. People using fundamental analysis have always looked at past performance of companies by comparing fiscal data from previous quarters and years to determine future growth. The difference lies in that the technical analysis belief is that securities move according to very predictable trends and patterns. These trends continue until something happens to change the trend. And until this change occurs, price levels are predictable. Now, the world of technical analysis is expansive. There are literally hundreds of different patterns and indicators that traders claim to have success with. While it can be advantageous to become familiar with as many of these as possible, it can be very, very labor intensive. Therefore, we will introduce you to the most important topics regarding technical analysis, such as the common types of stock charts used and key indicators you should be aware of as a trader. Okay, let's discuss charting, as this is crucial in technical analysis. Now, the straight line graph charting method, which you see everywhere as it is frequently used in newspapers and TV programs, lacks a lot of information as it is too simplistic for true technical analysis. Now, the two most common ways price action is mapped by traders is on a bar and candlestick chart. In front of you is one bar of a bar chart. This represents one interval of chart data. For instance, if you were using a 1-minute bar chart, then this bar would display information that occurred during a 1-minute time span. If you were using a daily chart, then this bar would represent one whole trading day. Regardless of the time span, the information displayed is always read the same way. The top of the vertical line indicates the highest price at which a security is traded during the time frame, and the bottom represents the lowest price. The closing price is displayed on the right side of the bar, while the opening price is shown on the left side of the bar. This stock chart seen here is an example of what a bar chart looks like. In this example, we are using a 2-minute bar chart. Therefore, each bar represents 2 minutes worth of data. The other popular charting method is candlestick charting, which has actually been around for hundreds of years. This charting system was used ages ago by the Japanese as a way to analyze price movement in rice contracts. Candlestick charts are very similar to bar charts in that they too display the open, close, high, and low. Taking a look at this candle, we see that the highest point is the highest price the security reached during that time frame, and the lowest point is the lowest price the security reached. Now, unlike with bar charts, candlesticks have what is referred to as bodies, which represent where the opening and closing prices were at. The larger the body, the wider the difference between the open and close was in that time frame. If the body is colored red, then the security closed lower than in its previous candle. And if the body is colored green, then the security closed higher. This stock chart seen here is an example of what a candlestick chart looks like. In this example, we are using a 1-minute candlestick chart. Therefore, each candle contains information concerning the price action occurring during each minute. Keep in mind that traders use several patterns within candlestick charting, such as the hammer and star, for indication of future price action. If you decide to use candlestick charts, you want to make sure that you become familiar with all of the patterns. Moving on to technical indicators. We will briefly cover most of these indicators, as we will talk extensively about them in upcoming video lessons. First, let's talk about moving averages. This is a chart using a 20, 50, and 200 moving average. Moving averages are easy to use and understand. They average the value of the security's price over a period of time, thus smoothing the price action of the security. Essentially, moving averages help you identify the trend. Next, we have support and resistance levels. Support and resistance are price levels at which movement should stop and reverse direction. Think of support and resistance as levels that act as barriers to future price movements in the same direction. Support is a price level below the current market price, at which buying interest should be able to overcome selling pressure and thus keep the price from going any lower. While resistance is a price level above the current market price, at which selling pressure should be strong enough to overcome buying pressure and thus keep the price from going any higher. If support is broken, it then becomes resistance. The same is true if resistance is broken. It then becomes support. Taking a look at this chart, we see a level at 2060, in which resistance was breached early in the trading day and then later used as support. Next, we have the Relative Strength Index, or RSI. This is used to interpret the strength of a stock by comparing the amount of time a security has spent up on the day versus the amount of time it has spent down. The index ranges from 0 to 100, and the security is considered overbought if it is near 100 and considered oversold if it is near 0. Taking a look at this stock chart, you can see the RSI at the bottom of the chart, which is currently at a level around 70. Now, moving on to Bollinger Bands. The Bollinger Band indicator uses 3 lines: the upper, lower, and the moving average, which resides between the two. While most traders use 2 standard deviations, the upper and lower bands are plotted anywhere from 1 to 3 standard deviations away from the moving average. A standard deviation is a measure of volatility. Therefore, Bollinger Bands adjust themselves according to market conditions. When the markets become more volatile, the bands widen. And when the market volatility calms down, the bands contract. The closer the moving average moves to the upper band, the more overbought the stock is considered to be. While the closer the moving average moves to the lower band, the more oversold the stock is considered to be. Now, taking a look at this stock chart, we see that the Bollinger Bands, which are in blue, surround the stock at all times, both above and below it, while the moving average moves around always somewhere in between the two. Ultimately, while these indicators are extremely useful, you as a trader should never base a trade solely on just one indicator. Instead, look for numerous indications to confirm a decision. And the last thing I will mention is charting patterns. We will thoroughly cover specific chart patterns traders commonly use in the next video lesson. But for now, it is important to make note that traders who use technical analysis heavily rely on price patterns visible on charts to make decisions on entering and exiting stocks. These patterns include the cup and handle, the head and shoulders, and the double top or bottom, just to name a few. It is the belief that history repeats itself that makes patterns such as these so important, as they have proven to be successful for those who know how to properly implement them. So to recap, When considering a security based on technical analysis, evaluate multiple key indicators, not just one. Utilize a bar or candlestick chart and spot successful chart patterns that have formed. Practice makes perfect when utilizing this technique. It is easy to get lost in all the information that technical analysis can throw at you. So remember, always try to stay within your current skill set and utilize the tools that you completely understand and are familiar with. Do not load up your trading strategies with indicators and chart patterns that you have not tested just for the sake of it. In this case, more is not necessarily better, as you could potentially get lost in all of the data. When using technical analysis, keep it direct and to the point. Ask yourself, what tools do you need and what do you have to see to make a decision on a trade?